Welcome back to Pass Your Life and Health Insurance Exam Podcast. Here, I'm your host, Biko. I'm excited to have you here today. So, today, what we're going to do is I'm going to bring you a recording of our uh, challenge, day one of our challenge, but this will be part two of day one. Okay, so it's going to be the second half of day one of our challenge. Remember, our challenge is a 5-day challenge. So we're just bringing you some of the training, some recording, so you can get a feel for what you're going to get when you enroll in the challenge. So day one was broken up into two parts. We had the test taking strategies. So that is something you learn in that's something you learn in part one. And you got that 2 weeks ago. So now this part two will be where we start the actual training. And this one was about the different types of insurance policies, or the two general types of life insurance policies. So term versus permanent, and we'll focus most of our time on permanent insurance. So I'm going to play this recording. So you're going to get to learn what students that attended day one of our challenge learn. So see you in the recording. So let's move on. The first thing we're going to do is types of policies. You can see my screen, right?
Yes.
Okay, types of policy. Let me enlarge this. And I usually have my document camera where I write stuff down, but it's not here today, but tomorrow I'll have it. So types of policies. So I'm just going to start here by saying, everything has different types. For let's take, for example, a car. You have different types of cars. You have SUVs, you have minivans, you have trucks, pickup trucks. I mean, you have different types of cars. You have electric cars, you have, hybrids, you have different types of cars. And each of those, and each type of car serves a unique purpose, but all of them serve one overall purpose, and that is to take you from point A to point B. Right? So every car serves like a general purpose, that is to transport you from point A to point B. But you may have different types that do different things. You have some luxury cars. If you want to show off, you can have a Ferrari. If you're a millionaire, you can have a Lamborghini. If your mom with 4 or 5 kids, you probably don't need a Ferrari. You probably need a minivan, right? If you're someone who um, um, you build houses, in that case, you probably need a pickup truck. So it's the same car, but it serves different unique functions. No matter the car, they all serve one big function, and that is to transport, to take you from point A to point B. So now let's come to life insurance. So life insurance is the same way. You have different types of life insurance. You have term life insurance, you have permanent life insurance, and then even on a permanent, you have different types of permanent. You have variable life, you have equity index life, you have universal life. I mean, you have so many different types of insurance. What I want you to know, the overall function of life insurance, and this will probably be on your exam. The overall function of life insurance is to leave or is to pay a death benefit. Okay, so let me repeat that. The overall function of life insurance is to pay a death benefit when the insurer dies. Remember, I gave you the example of the car, right? So the overall function of a car is to transport you, to take you from point A to point B. So it's the same thing with life insurance. The overall purpose of life insurance is to pay a death benefit. Now you have some life insurance that you can use it for retirement. You can use it for X. You can use it for Z. But no matter the type of insurance, whether it's term, it's permanent, variable, whole life, whatever, no matter the type of insurance, the primary purpose for all life insurance policies is to pay a death benefit. Any questions so far?
No, that makes sense.
Okay. And if you want me to repeat anything, just let me know.
Okay.
All right. So that's the overall purpose for all life insurance policies. Now, for life insurance policies, so here you have life insurance policies, and then you have two broad groups of life insurance, two major types of life insurance. And let me break those types down. You have, on the one hand, something called term insurance, right? And then on the other hand, you have, let me stop. Yeah. And then on the other hand, you have permanent insurance. So think about, when you think about term versus permanent, think about renting versus owning your house, right? That is the best way to think about it, renting versus owning. So for example, if you rent, you know that most of the time when you go to renew your lease, most of the time your rent will go up, right? And so every time you go to renew your lease, your rent will go up. Whereas if you own a house, you're paying a mortgage, most of the time, all things being equal, your mortgage payments remain constant, right? So that is one thing. Second thing, when you rent a house, you can have that house, you can rent that house or that apartment for 5 years or 10 years or 20 years. It doesn't matter. When you leave for nothing. You don't build any equity. There's no savings, nothing, when you rent. Compare that to when you own a house, you're paying a mortgage. You can own a mortgage, own a house for 5 years, 10 years when you're moving out or you want to, get rid of it. You can be able to walk away with some cash. So you have equity in it, right? All things being equal, most of the time, paying mortgage is more expensive than than renting. So that is how I want you to think about term. When you think about term, think about paying rent or renting. And when you think about permanent insurance, think about owning a house. So when you have term insurance, you're renting insurance for a fixed period of time. When you have permanent insurance, you own that insurance for life.
Okay.
Any questions so far?
No, that makes sense.
All right. So once you understand, and that's one of the things I like to do. I like to take these big insurance concepts and break it down to layman's level. So because I gave you everyday examples so you can be able to compare it to these things. Oh, yeah, okay. Term insurance is like renting a house. So when you understand that, then you know that you have no equity, so you can't take out money, from your term insurance because it's like renting. I mean, you can't go to your landlord and be like, give me money. You can't do that, right?
Pay me back last month's rent, please.
Exactly. Give me back last month's rent. So all of that, and you know that your rent will always increase at the end of your lease. So at the end of your term, your term insurance will increase. So once you understand that concept, it's going to help you to get most of those questions that will try to have you compare term and permanent. It's going to help you to get them right. All right. So let's talk about term in detail. So term insurance was the first type of life insurance. Is when you think term is just the short form, is the abbreviation for temporary insurance. So anytime you think term, think short term, think temporary. It's for a fixed period of time. Just like you renting a house, you can't rent a house indefinitely. I mean, I can own a house for the rest of my life, and I can, turn it over to my kids, and my kids can turn it over to their kids. It can go on like that. But term insurance doesn't work like that. Term insurance, as I say, is like renting. So so when you think term, think temporary. So it's temporary insurance protection. Okay, so temporary insurance protection. That's the first thing. The second thing is term insurance always is cheaper than permanent insurance. Because think about it, renting versus buying, right? When you're renting, it's usually cheaper than, again, assuming all things are equal, is the same number of bedrooms, same location, everything. Now, out of 10 times when you're renting, it's going to be cheaper than when you're paying a mortgage, right? So term insurance is cheaper. So that's the first thing we say is for a specified period of time is temporary. Number two is cheaper. Number three, third thing to know about term insurance is when you go to renew, every time you go to renew, it gets more expensive. So your premium will increase every time. Like for example, my dad had term insurance. He got a 10-year term insurance. I think he was paying like $125 a month, and then he went to renew last year. Now it's $200 it's like $215 a month. Same death benefits, same everything, but what changed? Your age. So term insurance gets more expensive with time. So just know that every time you go to renew your term insurance, it will get more expensive. Now that brings me to the next point here. Let me just insert this. On your exam, they're not going to ask you what does a teen age mean, what does death benefit mean. So these are insurance jargons. These are insurance lingo that you have to know. So on your exam, you're going to see something that will say attained age, attained age, ATTAINED, attained age. It's a fancy word that just means your current age. Okay? So your attained age means your current age. So anytime you sit down the exam, do not let that to chew you off. So with term insurance, your premiums increase. Why? Because your attained age increases. So your premiums will always increase, term insurance. Now, fourth thing to know about term insurance is that you have generally three types of term insurance. You have one that's increasing, you have one that is level, and you have one that is decreasing. What does that mean? What does increasing, decreasing, level mean? What increases, again, you shouldn't let the terminology fool you, like, what's the difference? The only thing that will change with these three different term insurance, the only thing that changes and the name is based after is the death benefit. So if your death benefit is increasing with term insurance, it's called increasing term. If your death benefit is decreasing with that term insurance, it's called decreasing term. If your death benefit will remain level all throughout, that period, if it's a 10-year period or 20-year period, if your death benefit will remain fixed, it's called a level term insurance. So for level term, for term insurance, the only thing that will change would be the death benefit. Your premium will always remain fixed for term insurance. So if it's a decreasing term insurance, on your exam, they may say for Mary had a decreasing, they will try to put in a lot of filler words. Mary, it's a 25-year-old nurse, and she bought of 50,000 decreasing term insurance. Which one of the following would changes in Mary's term policy? And then they'll say Mary's death benefit decreases, Mary's death benefit increases, Mary's premium increases, Mary's premium decreases. Don't let it fool you. Your premium will always remain the same no matter the type of term insurance you have. What will change is the death benefit. Any questions so far?
No, that makes sense. I didn't know that. Why would anyone want decreasing death benefits?
Oh, perfect. And perfect. So let's talk about the uses of term insurance, or the different uses for the decreasing death benefit. But before I can come to that, just want to add everything. So as I go along, I'm going to define these vocabulary, these terms for term insurance. So for on your exam, again, they're going to put these words there, these terminologies that they're not going to ask you directly, but you have to understand what they mean to get the question right. So death benefit is what you receive, what the beneficiary receives when the insured dies, right? So everybody knows death benefit, but death benefit also has other names. So another name for death benefit is face amount. Okay, face amount, death benefit is the same thing, and they call it face amount for a reason. Usually, back in the day, long time ago, when they deliver your policy, the first thing on your policy, right, the first number on your policy, it was usually on the first page was the death benefit. So that's why they call it the face amount, because it was right there in your face. Yeah. So the face amount. So just know face amount is the same as death benefit. Another name for death benefit is policy proceeds. Policy. So on your exam, they may not say death benefit, they'll say policy proceeds, and you're like, what is policy proceeds? It's just a fancy name for death benefit. Another name for death benefit is limit of liability. Limit of liability. So limit of liability, it makes sense, right? Because the limit of liability, that's the maximum amount the insurance company is liable not to pay for, right? In the case of the insurer's death. So limit of liability. So death benefit, you can call it face amount, you can call it the policy proceeds, you can call it limit of liability. It all means the same thing. Any questions?
No, I'm writing all that down because I didn't know the last one.
Yeah, limit of liability. All right. So now we move on. So for term insurance, I said those are the three different types: increasing, decreasing, and level. So why would someone use decreasing term insurance? Decreasing term insurance is usually used in credit life insurance. What does credit life insurance mean? So let's just say I'm the lender, and you want to borrow money from me. But I say, geez, let's say I borrow you $50,000, or I lend you $50,000. But I'm like, God forbid, what if Lexi dies tomorrow? How am I going to get my $50,000 back, right? And that happens all the time. You lend someone's money. Of course, the person is, if the person dies, you can't go back and say, oh, there's no way to collect your money. So what some lenders do, they say, okay, you will have to get life insurance on your life so that I'm guaranteed to get my money back no matter what. So God forbid you die, that life insurance is going to pay me what you owe. So usually, and we're going to get to credit life insurance, I think, later on, maybe it'll be in the state portion. But usually what they'll do is now, the lender will be the owner of the policy, and the lender will be the beneficiary, and the borrower will be the insurer. So now they have that. So the decreasing term insurance comes in they'll structure it in such a way that every year as you pay off that mortgage, as you pay off the debt, and that debt could be a mortgage, it could be something, but every year as you pay down that debt, then the debt benefit will decrease, because the whole point of it is not to make the lender rich, is to just pay the lender what you owe them, right? So the structure where it's decreasing because it's assumed that you're making your payment over time, your loan balance will decrease, so your debt benefit should also be also decrease with time, because that is what will go to the lender. So that is what decreasing term insurance is used for. It's usually used to cover loans. So it could be a mortgage. So someone could get someone could get a decreasing term insurance for a mortgage, payment. So like, okay, I know every year I pay my mortgage is going down. So if I need that term insurance to pay off my mortgage, then my debt benefit will decrease every single year as I pay off my mortgage.
Okay, yeah, that makes perfect sense.
Yes.
So mostly just in terms of lending money.
Exactly.
You can use this as an option. Okay.
Yeah. So that's decreasing term insurance. The other type of term insurance is level. So level, the death benefit does not change. So that is usually, so just know that most term insurance, there are level term insurance. So we see that term insurance is used in group life insurance policies, right? So all group life insurance policies are level term insurance. Another name for it is ART. It means annually renewable term. So every year, once you're employed with that company, every year your life insurance automatically renews, right? So that's a level term insurance, right? And so most term insurance people get, whether it's an individual term or as a group term insurance, most of it, I'll say about 95% of term insurance, or I'll even go 98% of term insurance is level term. Like if I get term insurance, I want a $500,000 death benefit, I get it for 10 years, that will remain fixed for 10 years. So know that. So they may ask you which of the following is a type of decreasing term insurance. Do I have credit life? Do I have annually renewable term? They may have their return of premium, and then D, none of the above. So you got to know the type. So credit life is an example of decreasing term insurance. Annually renewable term or group life insurance is a type of level term. And then let's get to increasing term. An example of increasing term is return of premium. The return of premium. So what return of premium does is, I'll tell you from experience, about only 2% of term insurance policies pay out. That means that only 2% of people die while their term insurance is active. Only 2%. This is one of the reasons term insurance is cheap, right? So some people have problem with that. They say, well, so I should just pay this money and it just goes to waste. If I don't die, then the insurance company just keeps all my money. That doesn't make sense. So insurance companies came out with something called return of premium. That's okay. That's fine. If you don't die, what we're going to do is we're going to give you back all of the money you pay in premiums. We're going to pay all of that back to you. But if you die, then we're going to pay the death benefit plus all the premiums you pay. So let's say over the course of 10 years, you pay a total of $50,000 in premiums, and then your death benefit is $200,000. So now when you die, instead of your family getting $200,000, you'll get the $200,000 plus the $50,000 you pay in premiums. So they'll get $250,000. So your death benefit is increasing. That's why it's called. That's why it's an increasing term. Term policy. So it's called the return of premium policy. So that is a type of increasing term. So when they gave you that on the exam, these would be the 3 examples.
Okay, that's okay. Perfect. It's awesome that you can get all that back.
Yes, but keep in mind that return of premium term is usually, not even usually, it's always more expensive than
Right.
regular term, right? Because your death benefit will increase, so the insurer would charge you a little bit more. Okay.
Makes sense.
Yeah. All right. So we've covered term insurance. So what I like to do, because I could go on for the next year and just next uh 1 or 2 hours and just yap. So what I like to do is make sure people understand what I explain. So I'll stop here and have you explain in your own words. No, let's assume you are teaching me about insurance and I know nothing. So in your own words, teach me about term insurance.
Okay. So term insurance is going.
And I'll just add, please do not look at your notes, okay? Just
Okay.
do your best. There's no right or wrong. You are here to learn, so you shouldn't be ashamed.
Okay. So term insurance is for a fixed period of time. You can't take any money out on it, but you can use it in terms of loans to cover loans. But when the insurance period ends, the cost is always going to increase when you have to renew. It's not fixed in terms of premium price, which is why it's cheaper than a permanent insurance option. And there's 3 types of term insurance. There is increasing, which is where you can receive a return of premium payments if you haven't died during the time frame that you signed up for. As well as your beneficiaries can receive a death benefit plus the return of those paid premiums upon your death during that term. There's level term insurance. That's where the premiums stay the same amount. Is that correct?
Well, the premium always stays the same.
Okay. So nothing really. I mean, they mostly are used, I know, in group policies, and they are. There's, I know, availability to annually renew. Does the premium stay the same when
Yes.
Okay.
So all you got to know is the premium for term insurance will always be the same. The only thing that will change is the death benefit.
Okay. Perfect. And the last one was the decreasing, which I mentioned earlier can be used in a loan purpose or credit life insurance, where if you needed to take a loan out, whether that was to pay for a mortgage or something else, the payments that you're putting into essentially is paying off that loan, and so it's decreasing each payment that's made. The death benefit amount is decreasing, and that death benefit would go to the insurer, since they want to ensure that they're going to get their money, the money back that they've loaned you. So they're your beneficiary almost, in a sense. If you were to die, they would still get their money back.
Perfect.
Okay.
Okay.
That's all I got.
No, you actually did very well, and that's what I like to do, right? Because again, as I say, I can come and yap here for 2 hours, and you think, yeah, I know it, but you really don't know it. But when you can explain it in your own words, yeah, it may not be like perfect, but if you can explain it in your own words, that shows to me that you really understand it, because you won't be able to explain anything you don't understand. So
exactly.
That's good job. All right, so we're about to wrap up here, so I'll just conclude. I'll touch on permanent a little bit. So that is term insurance. Again, what I just gave you is like the just general breakdown of term. Now, on your exam for term insurance, if you just learn all these things I just told you, of course, you have the practice questions to learn more, but this is pretty much it, for term insurance. So
Okay.
it's not that complicated. You can, on your exam, you should expect between 1 to 3 questions on term. Between 1 to 3 questions on term insurance. But you get at least one question. So, but once you understand what I just said, you should be good for term insurance. So next thing here is permanent insurance. So maybe what you could do, you just learn one and just know that the other is the exact opposite, right?
Yep.
Because they're opposites of each other. So we said term was for a fixed period of time, is temporary. Permanent insurance, as the name says, is for life. It's permanent. It's like you own a house, right? You pay mortgage. It's for you. It's for life. You can turn it over to your kids and everything. It's for life. Now, for all intents and purposes, they say life, but technically not life. It's up to age 100.
Mm-hmm.
Okay, but nowadays, who lives until age 100, right?
So, I thought modern medicine. I thought we were supposed to. We're getting there.
Well, let's wait and see. I don't know anybody who is 100 years old. Like, I mean, I see a few on TV, but I don't know any person that's.
I think our lifestyles and advancements are actually going against us.
Yeah, so let's see. But just know, for exam purposes, know that permanent insurance is for life or up until age 100, whichever comes first. So it is permanent. The other thing about term insurance is for permanent insurance, know that it's always more expensive than term insurance. So again, all things being equal, if it's the same individual, same age, same everything, same death benefit, term versus permanent, the permanent insurance will always be more expensive. It's usually 3 to 4 times or even up to 6 times more expensive. So it'll be more expensive. The other thing you got to know about permanent is now you actually build equity in your life insurance. This is one of the good things about term insurance. So just like you have a house, right? You pay your mortgage for a couple of years. If things get tough, you can always go and withdraw money. You can take money out of your house, right? So it's the same way with permanent insurance. You can withdraw money, and what makes that possible is something called cash value. Now, again, they give you all these terms that sound big, confusing, but cash value, think about cash value as your savings account. Okay? Think about cash value as your savings account. And then under cash value, there's something called cash surrender value. So cash value is like your savings account. Let's just say it's your account balance. And then your cash surrender value is your available balance. So sometimes your account balance and your available balance are not the same. your account balance may show 10,000, but your available balance may be 2,000, right? So your cash surrender value is the available balance that's accessible to you for you to withdraw, right? So just know those two distinctions. Cash value is the money that is there for you, but cash surrender value is the one that you can take. Now you may say, but why the difference? So your cash surrender value is just your cash value minus your surrender charges. What does surrender charge mean? Surrender charge is just an early termination fee. Right. So the life insurance, they want to make money, right? So if you get your permanent insurance and you cancel it in the first 1 or 2 years, the insurance companies are not really making money, right? The longer you keep your insurance, the more money they make because they will take a portion of that premium you take, you pay, they'll invest it and make return. So what they do is they penalize you, and that penalty is called a surrender charge or surrender fee. All right. So it's usually a percentage of your cash value. It will start off being 10% or 15%, but usually what happens is every year that your policy is in force, that surrender charge decreases, by a percentage. So by the 10th year, then it goes down to zero. That means you can cancel your policy or you can have access to all your money. So your cash value is the money that you have, and the cash surrender value is the money that you can take. It's your cash value minus your surrender charge. Okay. So as long as you're not taking any money out, that's fine. But if you're taking any money out, then they're going to penalize you. Think about it, almost like when you have a 401k, you go to take out money from your 401k. Yes, it's your own money, but they're going to penalize you. They're going to, I think it's 10%. So we'll get to that in chapter 4. They're going to penalize you, right? So that is what your cash surrender value is. So with permanent insurance, you can take money out of your policy. You can take money out in a form of withdrawal, or you can take money out in a form of a loan. But just know, just like a house, you can be able to access money from it. You can be able to take money out. So permanent insurance has living benefits, right? They have living benefits. Living benefits are benefits that you don't have to wait to die to get. You can actually get some while you're still alive. So again, we'll get to that when we get to chapter 2, the policy riders and provisions and options. But just know that permanent insurance comes with living benefits, right? Term insurance just comes with death benefits. There's no living benefits. Now, that is just for exam purposes. In real life, you have some companies like Transamerica and Prudential. What else? Pacific Life. These are some companies that your term insurance actually has living benefits. And so you can get some things like the long-term care rider, all of those things are attached to a critical illness. But for exam purposes, just know that term insurance does not have any living benefits. Permanent insurance has living benefits. Let's see here, what else. So that's pretty much it. So that's the general thing for permanent insurance. Number one, it's going to be more expensive than term. Number two is for life or until age 100. Number three, it comes with living benefits. What are some of those living benefits? It comes with a savings account, and we call that savings account what? What's the name for that savings account?
Cash value.
Cash value, perfect. So you can make withdrawals, you can take policy loans and all of that, and it can be used for a lot of things. It can be used for retirement. It can be used for other purposes. So that is permanent insurance. You have different types of permanent insurance. So when we come back tomorrow, we're going to go over the types of permanent insurance. You have, variable. You have variable insurance. You have whole life, universal. I mean, you have a bunch. So we'll go through all of those. So what I'll go ahead and do is so your assignment, I gave you access, and that's why I like people to be on their computer. Are you able to share your screen?
Yeah. Let me see.
Okay, so just share your screen and then I'll walk you through everything.
Okay.
And just again, since this is recorded, you want to make sure you get rid of any.
Right, of course. Okay. Let me. So where do you want me to be when I open share my screen?
I want you to log into the self-study course, the portal, and I'll tell you what your assignment is.
Okay, let me do that first. Hold on.
Okay, that's fine.
Menzo pass. Okay.
So I'm going to give you a lot of work. I know, again, you have 24 hours, right? So
okay.
You want to put that time.
I'll share my screen and then you can just let me know if I'm in the right place.
Okay, that's fine.
Let's see. Okay. So I was up over here. Can you see?
Yeah, you want to enlarge? You want to enlarge your screen?
Oh, is it not?
No, I can see it, but like, can you do a full, how do you call it? Maximize it?
I can maximize. Oh gosh.
Oh,
It is maximized. I'm not too sure why it looks crazy.
let
I
me,
think you have to maximize.
okay, let me see something here. Just, I can see it, but not in,
Not a large mode.
yeah, okay, let me maximize.
You know what? Hold on. I think I figured it out. I think I only had it sharing one screen. I'm trying to share everything. That's why. Okay. Entire screen. Okay. Is that better?
Yeah,
and then I was going over here.
Okay.
Can you see the challenges?
Okay. So I'm see it. But can you maximize it?
What's that?
Yes, still. Okay. That's now I'll try. Okay. So your no, go to file that link before right? The course.
Sorry, you're cutting out a little bit. This is sorry.
Oh, that's it. So I'm saying for the course that you register for, the one that's saying the coupon.
Oh, okay. How can I? How do I access that one?
Okay.
I went to your website.
Okay.
I can't remember how I accessed it.
Okay. And then oh, okay. Well, you can go scroll down. Okay. Yeah. I don't know. Missouri.
Oh.
Gotta go back.
This one?
Yeah, Missouri.
Okay.
All right. You see, so that's right. So, overview of this title, you can follow that pretty much. Where's that from? Say from yeah. Okay. So you can follow that. Help test taking is again talked about. Skip it. Can skip. Okay. So you see chapter 1. So your aim is to do all this, include the chapter for.
Okay.
So it's your it counts out of video. I'm getting back. I don't know. Like I'm
here. Yeah, I think I did something wrong. Give me 1 second to stop sharing. I'm sorry.
Okay. It just went. I don't know what happened.
It was sharing the audio. That's why. So I just fixed that. I just changed it.
Okay.
So I can hear you a lot better now. Sorry.
Okay, perfect. All right. So your assignment is to finish all the quizzes for each of those topics, right? You got it. Now, if you want to, you can watch the videos, but you got, I think, almost 5 hours of video just for chapter 1, video explanation. So if you got time to watch the videos, you even learn more, so that tomorrow when you come, it will even be easier for you. But as soon as you don't have time, the bare minimum is to go to all of those and and just take the quizzes. If you fail them, that's fine. But take all of them. Try to read the explanation, see why you got it wrong. But take the quizzes for all of chapter 1 and then chapter 1 exam.
Okay.
And then, because when we come tomorrow, we have limited time. So when you do that, now I will just come and just cover those ones that you don't understand, like the parts. Because we're not usually, like, what I'm trying to do. This is our boot camp. Of course, we do the we include the law and all of that, but I'm trying to condense something that we're doing in 3 weeks. I'm trying to do it in 5 days, so it's going to be a lot of pressure, a lot of work on your end. So that's it. So that concludes it here. Any questions, any comments for me? That concludes our day.
No, I have it all squared away, and I will get to the quizzes before we start tomorrow in the exam for chapter 1.
All right, Lexi. So when you come tomorrow, please, you know, I know, you know, we said it earlier, but the camera on, and then
Okay.
we'll go from there. So it's going to be the same time tomorrow, and hopefully we can have some of the other people from last time. We can have them here. So thank you very much, Lexi, and
thank you.
see you tomorrow. Okay.
Okay. See you tomorrow. Bye-bye.
All right. Bye.